The unemployment rate fell to 4.3% in May, the lowest level since May of 2001. But it's not all good news. Here are 3 things to know about the May jobs report. Number 1, 138,000 jobs were added to the economy in May. That is significantly lower than economists expected. In fact, year-to-date, monthly average job growth now stands for this year at 162,000. That is down from 186,000 a year ago. And while some believe hiring is slowed because companies cannot fill their positions with qualified workers, 2 key points in the report suggest otherwise: the labor force participation rate and wages. And that's number 2. Monthly wages inched up 0.2% in May and 2.5% year over year, and the labor force participation rate fell to 62.7%. What does that mean? Well, if employers were really having trouble finding workers, you'd think they'd be offering higher wages, meaning wage growth would rise, and if wage growth was rising, that labor force participation rate, which measures how many people that could be working actually are working or are looking for work, well, that number would be higher. And number 3, how will the Federal Reserve react? Fed officials have prepared Wall Street for an interest rate increase when they meet on June 13th and 14th. This jobs report probably isn't weak enough to move the Fed off that track, but slower job growth could have ramifications for Fed policy and the economy for the second half of the year. So how should investors gauge this jobs report?
The labor markets are tight, and the market doesn't sense any inflation on the horizon. Hourly earnings are up a bit, but we're not really seeing any wage inflation. That's something to be watchful for, because the most important thing for fixed income investors is what happens to inflation over the next several years. Think long term, not short term.